Hello, everybody, and welcome. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. I also work with founders on their pitch decks and executive summaries because you all need help with those. And as Atul will point out soon, I'm sure. And I make introductions to strategic partners and investors where and when appropriate. So welcome and thank you for hosting us, Joseph. Joseph, tell us about you.
Morning, everyone. Name's Joseph Katz. I am a startup marketing guy. I help companies go from unknown to well-known using back to the basics, marketing strategies and tactics, go-to-market strategies and things like that. We keep the intros short, so I'll put my contact information in the chat, but looking forward to today because I recently completed 2 projects in the entertainment space, so should be fun.
Wow.
Nice.
So, Atul, you want us to go around the room or you want to tell us a bit about yourself first?
Now let's go around the room again. I met some of you all, but let's go around the room again. Get a pulse.
Okay, Ian, take it away.
Good morning, everybody. Ian Garmes. I'm in Toronto. I'm the COO of a company in LA called Virtual Film School. And as of now, we are a marketing consulting firm working with a tech firm in Texas to help them launch their new platform. And I'll put my contact info in the chat.
John, tell us about you.
Hey, Bonnie. Thanks for having me as always. My name is John. I'm from Los Angeles. I work as a fractional executive. Currently, my gig is with a commercial real estate finance firm. They want me to partner in full time, so we'll see where that goes. But my background is actually in healthcare. I work as a fractional executive, though, and I'm open to new clients.
And welcome as usual, Scott.
Yes, Scott Purdy. I'm representing Cine now. I'm one of the founders of Cine, where we have that app that's going to take multiple videos, movies, input from anywhere around the world, basically, and in a very short time upload a finished professional video/movie. I do a lot of different things. I worked at Camden County College for 26 years. I was in most of that time distance learning, doing all the online courses. I also do some part-time construction. I'm an actor. I've been doing pretty well with that. So I keep busy. Plus, I babysit grandkids. So I really have, but I love these. I don't know, Bonnie, I've been coming to these for a long time. So I love these breakfasts thing. And I'm interested in hearing what Joseph is doing in the with the entertainment stuff there. Yeah, I know what Tool is. Yeah.
The breakfasts are always different. Every single investor has something different to say. Dick John, who I know from New York, but we are not in New York anymore.
I am actually. I just got back last month, so mid last month. Was away working on this AI product, which is a compound AI product that helps you find, create, and automate documents from multiple sources, as well as it can work on premise and off premise. For those of you who are wondering what that is, it simply means that you don't have to use Amazon or ChatGPT or whatever. You can use your own local box or a PC or server, for a better technical explanation of it, in your premises and run it. And then we have
we try to keep the introduction short.
yes.
But you can put your
and I've been coming for these breakfasts for about, I think, about 10 years now, I think.
Yeah, that's right.
Yeah.
And welcome back. Good to see you, as always. I don't know if Andrea can introduce herself. I know she's traveling and she's muted and off camera right now. So I'm guessing that's no. Andrea is family office. So she invests to a family office. Or she can put in her information in the chat if she'd like. Frederick, tell us about you.
Hi, my name is Fred Steinman. I'm an accountant, consultant, work with a lot of entrepreneurs, tech, media, and also artists. Currently I'm doing consulting work and tax work with a law firm that focuses primarily on crypto clients.
Oh, thank you. Natalia, tell us about you.
Yeah. Hey, how are you? I'm Natalia, and I'm from New York City. I do UX design and fractional AI strategy for fintech and SaaS companies.
Oh, great. Don't forget to put your contact information about you in the chat. So I know other
Okay.
people signed up and they'll wander in as they always do, but Atul, take it away.
Yeah,
Or
Frederick.
I should say, Professor, take it away.
No, I'm not. No, I think that's for full-time people. You should call them professor. I'm just kind of a guy that hangs out for a couple of weeks in the semester. Frederick, what kind of artists do you work with?
Various, musicians, right now, guy who wrote a book, trying to get it translated into a screenplay.
Huh.
And,
All right.
and also actually working on something myself with that. I'm a bit of a writer, so I'm working on a film as
I'm
well.
saying you look like you could be an actor too, like got the cool vibe.
In my astrology, yeah.
Awesome. Okay. Cool. I also quickly jump in. We met a couple months back, and then I was at I attended some with a bit. Welcome. Sorry. Happy to see you all again. Good morning. And I've chatted with a lot of you, Ian, since last time as well. But a couple new faces. It's a pleasure to meet you all. I'll quickly get out. I run a venture group, disruptive tech, and sports and media. Then we've jumped into like setting up SPV, special purpose vehicles. So the one I told you about last time was probably because it was already in existence was Rasa Film Fund. I'm assuming I told you about that. Just back films.
Yes.
And with female protagonists, generally from the South Asian diaspora, but like we'll see where that's going because there's some movies that are just amazing that we want to be a part of. So then we got together last year, 4 partners. We blown that out to 5 this year because there was some interest. We saw now we're looked at 70, 80 scripts, whatever it was last year, got behind 5. This year, we're going to targeting 2 features that we already. Oh, this is going to go online. We're negotiating right now, so I shouldn't even talk about this right now. So there's that. And then next year, I think there's a lot of interest. We might blow this out to a few more LPs. So there'd be 5 core GPs essentially in this SPV, and then that. Another SPV we're launching is in the sports arena, just because there's been tremendous, actually, Scott, I think, with the gentlemen that are going to be in Texas, Garrick, one of them, another person who's from family office space, and then 2 of us who've run venture deals. So we've been in each other's circles for a long time and investing in that. We all have our independent things. And then, but family offices want to be involved heavily in disruptive tech or and just plays in the sports arena. So we thought, well, let's set up not a fund per se, but an SPV, a special purpose vehicle where you raise per project essentially, because there are 3 that we want to get behind already. So, and then there are a lot of athletes that would come to us and want exposure to the space, just wanted some guidance initially, right? They're all incredibly sharp and they have their own phenomenal brands that they want to leverage into this space. So we thought, let's just put this all together. Let's put together one for this year and get behind 2, 3 projects that we already know. There's 20 projects we can select from. There's 3 that really make sense for us with all of us 4 kind of GPs involved, and we're doing that. So I will announce that that's coming within a month or month and a half. We're just working on some kinks, and then the first project will initially be launched about 2 months after that. I'm sorry, a month after that. So 2 months from now, because we're already deep. It just made perfect sense because we all are traveling the same circles, see the deals. See the value in some of these projects that are coming our way. So let's get behind them, just support them. And the main part of it would be from an educational standpoint for a lot of different people. Anytime we speak, any of us speak anywhere, a lot of people ask us, hey, give me some more deets on your background and how I can get more involved in this space. So in my particular case, it's investing in sports and media, entertainment, let's call it. So I always get those calls. So it ended up being that I was between coffee chat, coffee meetups or a drink or Zooms, it ended up being like 10 to 20 hours of my week. And so away from the full-time job. So I had to kind of feed my kids once in a while. So I thought, okay, what's one way we can make this more efficient in a low cost, effective manner for people to learn venture because everyone wants to learn it. So I said, hey, I'm teaching this course over 14 weeks. Let me just consolidate that to people who don't have time to do that and don't want to do that. I get it. I wouldn't want to at my age, but let's do it like it's 3 hours of content into like 35 videos, roughly 34 videos, and around 5 minutes each. And we'll chat about that later. So that's how this whole thing came about. So it's an education standpoint. Yeah, Bonnie.
I was going to say, you also do your podcast, and you should put the link in the chat. So speaking of sport,
I will. Yeah, it's called the Whiskey Hue. We do sip a little whiskey while we're recording, maybe a lot of whiskey, but then we talk about basically business, tech, and culture. That's pretty much all I kind of know about, right? I can go into healthcare topics as long as an expert's with me and guiding us, and I'll just ask the questions that all the rest of us want to know. So, but that's how we do. I'll put the whiskey hue in there later on, but for sure. But it's fun. So I started with a couple other folks like 4 or 5 years ago. They've had to drop off, but it's been a great biz dev play. It's been phenomenal, and it gets me to I get to speak to a lot of my heroes. A lot of them are athletes, a lot of them are executives, and from different diasporas, right? So we bring them in and we chat about a lot of different things. So back to the education component, my whole thing is I want to kind of just venture is I've seen teachers come in. You don't have to have a deep financial acumen to be a superstar in the space. You can be a great operator, executor. You have to come in with a couple things: capital, resources, relationships that you can unlock value for whatever company you're dealing with, or as an operator, or deal flow. There's a couple, like 3 to 4 ways you can get into this space. So I thought, well, let's consolidate that, and I created a course around it, and we'll chat about that later. But that's how this whole thing started. A lot of folks that just happened in my circle were athletes, NFL or NBA. That's kind of mainly where I kind of cross. Less MLB, NHL. We know a bunch. There's one who's involved that will be involved with one of our SPV projects because one of them is his project. I think he played for the Dodgers. I don't know MLB that well, but great guy. But a lot of the folks in this space, if you don't know the private equity at the venture model, you can maybe know the private equity model where you take 100% ownership of a company. At the smaller scale, how do you learn about it? So that's how we kind of started this whole thing. And then we thought, well, this SPV could be a hands-on approach for a lot of these athletes that we're working with anyway to kind of learn, put some skin in the game a little bit, right? We're going to take from them. A few of us will have larger lead checks, I think, and then be smaller checks from a lot of the athletes, up to as much as they want to write. It's up to them, but there'll be just a smaller minimum than you generally would have, and as an educational tool to kind of be involved. And what they're bringing to the table is like some sort of value unlock, as far as it could be a branding or partnership, because they're brands themselves, right? And they've done phenomenally well, and a lot of them in media tech. And we're going to explore the crypto space, and we'll talk to you about, there's some AI things, and I think somebody brought up, AI is, you have to have some sort of AI to get a lot of funding. It just gets you an extra couple mil just by putting that in your name right now, it's FOMO. It was crypto a couple years ago. Before that it was SaaS 6 years ago, whatever it was, right? So now SaaS has gotten quiet because SaaS, technically, you wanted to have a lot of employees, but now with AI, the companies with fewer employees are getting better funding because we're saying, hey, you're actually operating properly in this domain, in this arena. So my whole thing is I want to do disruptive tech in sports and media, so the broader umbrella, entertainment, and just vehicles in that space to kind of push those ideas along. So that SPV, which will be announced very shortly, I'm excited about that. The 2 of us are heavy investors in that space. One is a retired athlete, and I think Scott knows about him. I think he's the one behind that event in Texas because he's from there. And then another partner, she's big in the family office space. And family offices, we're in a uptick where, hey, there might be liquidity in the markets eventually once we kind of figure out what's going on in the next few months. And then they're going to want to deploy capital in this space. They're already wanting to just have a little bit more exposure to alternative investments. So that's kind of that in a nutshell. Yeah, Bunny.
I was going to say, I know who you're talking about, and he's a great guy, and I will not mention his name.
Yeah, you met him. Yeah.
I love him. And family offices are getting a lot more involved in investing these days. And family offices are different. They are much more patient money. Do you find that that's true?
Yes, because a lot of times, I think what happened is there was this, from the couple of terms with Obama through the first Trump through the one and only Biden, we had, outside of a few blip years, we had pretty good markets, right? So a lot of people absorbed they grew their wealth and are ready to kind of deploy capital in this space. So a lot of family offices were created at that time. A lot of venture groups were created in the last 5 years. A lot of them are folding shop as well because a lot of people had access to liquidity, to capital, and wanted to deploy it. It's hard to run a group, a fund, and find deals that you can exit at a later date and do incredibly well with on a consistent basis, right? So that's I think people are learning that. So then a lot of them are returning capital as well. So family office, same thing. A lot of families grew their wealth, or individuals are parking capital within these family offices. But then the family office, sometimes they're always in the legacy plays, right? Generally, real estate or whatever the family business was in that arena. And then they would do kind of safer investments. And they still do that, probably 80–90%, but they want to take 5 to 10% allocation towards maybe some alt investments with some high risk, high reward type plays as well. So that's why you're seeing that. We're seeing that unlock happening big time right now.
Sorry, I didn't mean to interrupt.
No, that's Bonnie, I just kind of keep rambling. I have to give a shout out to Bonnie. I adore Bonnie. She walks in, she owns the room. She stands like she's 6'5", but like you're just I love being around her. Like seeing you at that event on January you're a blast to be around. So I appreciate you all the time. You bring a lot of energy, which is great. And we know a lot of common people.
Yes, we do. Well, I wouldn't call them common. We know a lot of people in common, but we don't know common people.
Okay, well, they're eccentric.
I did want to give Alex a chance to introduce himself. And I don't know if you want to keep talking and about the first two, or if you want to see if there are any questions from the room.
Well, yeah, Alex and whoever didn't do an intro, jump in, please.
Hey, sorry, I was delayed on a prior meeting, but absolutely looking forward to hearing all about your endeavors. I'm Alex. I've known and share your feelings about Bonnie. We met on a slightly different forum, but very similar, and she's always massive value add. And she was nice enough to invite me on her show, which is pretty much what I'm calling it. But my background, I'm an investment banker. Everything M&A, debt, equity, and then got into private equity, basically rolling up specialty lending operations, specialty finance, thinking of like factoring companies, asset-based lenders, etc. Did that for a number of years, and last year figured out, that whole space is just based on decades-old technology. None of it is taking advantage of the technology that you have out there already capable in terms of AI, machine learning, OCR, all of these things that have come out in the past 5–10 years.
Remember, we have to keep it shorter. We have to keep introduction short, so you have to.
Oh, okay, yeah. So basically, I figured before I turn 50, let me do my first startup, and that's where I am. It's a fintech company. We're actually looking for capital this year, expecting to launch in May, and that's kind of, my background.
What's the angle in the fintech? What's the unique angle on it?
It's software as a service, funny enough, but it's the AI aspect. It's AI native. It's the only offering like it in its vertical that is AI native and machine learning capable, all of that. So it's vertically integrated, and it's enterprise software for specialty lenders.
Okay, nice.
So it's boring, but at the same time, it's cutting edge in terms of technology, but it's nice and boring.
Great solutions in that space, and those in boring arenas make a ton of return, have a great upside, right? If you get it right. So good for you. Kudos.
Absolutely. Happy to send you a deck, etc. as a VC. Although I think your specialty is a little bit different. I did have, so I'm constantly asked to raise capital for different entrepreneurs, etc. There's a company, funny enough, in your space, apparel, which I know sports and the two. I mean, you've got like the shoe behind you, right? Apparel and sports are one of the great kind of mergers of all time in terms of marketing, etc. Would you look at the apparel companies in terms of
we wouldn't because it's tech, but I could push that to some folks that I know. So a lot of us know each other, right? So we'll push things to them, to folks who it makes more sense for them to take a look at because they have domain expertise. I do not in that space. I do know Fanatics is the superstar in that space. They've gotten exclusive contracts with the way he's run that has been phenomenal, and he's he's the perfect founder who still operates as a founder after he's a billionaire already. He just runs through any wall to make something work, right? Which
Yeah.
that's what you want to see in someone like that. But yeah, I can put you in touch with someone. I know someone who's doing. I didn't invest in it. My friends have invested in it. It's a company that takes excess inventory from the LVMHs to Macy's, and they find online distribution channels for it globally, which that wasn't in
Yeah.
existence in an efficient manner, apparently. So he's created that, and they've raised incredible capital and tremendous amounts, and seems like they're doing incredibly well. So I probably should have gotten involved. but I don't know the space. That's not my space. But yeah, I could probably put you in touch with somebody. Has anyone else raised capital or been in the business of, like, you've raised capital or are looking to in the future? Joseph has. Joseph, what are your entertainment deals that you've been a part of?
Well, so I raised capital years ago. I helped raise capital years ago because I worked in startups, so I was involved in that process. The entertainment projects, one's a small comic book company that's trying to to go from comic book to film, and I basically worked on their social media growth. And then the other is a very large multinational. I don't know if I should use their name on the recording, so I'll leave it at that. Just think big screens, lots of noise. Also help them expand and build their social media presence. So been all on the marketing side on the entertainment stuff, growing
The first
there.
one, a gentleman that just spoke in my class, and Ben, you and I can chat offline. He's great. He's
Yeah.
phenomenal. Been in that space for a long time, has crushed it. We're looking at something together right now because that falls right in my media and genre.
yeah,
If
for
you want
sure.
to connect with him, he's amazing in that space. He's a
Yeah, I
writer
wrote
for
down.
comic books, and he's done all that at Marvel. He's behind, I think, the Werewolf and Spider-Man, and a bunch of different endeavors there. But he's worked with a lot of music artists, which is where my background was before, and we've probably collaborated with a lot of the same folks. We're just coming to know each other in the last little bit. So he's great. So I could connect you if that'd be helpful.
Yeah, I'll definitely. I wrote down to reach out to you about something else you mentioned. I'm actually
Okay.
very interested in your class. We had someone on this breakfast years ago, Bonnie Joel, who also does like a course for people who are
Yes,
interested
yes.
in the world of venture. He has a very different model, but it's something very interesting to me. I worked in the online education space for 10 plus years. So
Oh, nice. So here's the thing. So all of you have really unique backgrounds. You want me to, because it's a lot of people that come to us, the questions they ask are, and these are surgeons, doctors, accountants, engineers, marketing execs, so they're really smart people, or just even like someone who's just kind of green into this space. They always ask us like, hey, what, how raising capital, how it impacts the number of shares once you're in that arena, how it impacts the number of shares, share price, share dilution, cap tables, post-money valuation, equity stakes, how they differ. Do you want to see any of that? Do you want me to just I can pull up a deck on that quickly. I'm a nerd, so I'm kind of operating like a finance, but I'm a numbers nerd. So let's chat that. Hold on.
Yeah.
I could do that. Sorry,
for it.
if that's helpful, I could do that. Okay, let me
go
okay.
for it. The valuation conversation is always a
Yeah,
fun
this is
one.
great. No, this is
That's
a good
good, yeah.
lesson for founders.
Okay, shoot. Now I gotta find it. I'm gonna speak on it later anyway, so I thought let me just pop it in.
Where do you teach?
So sorry, yeah, I teach graduate students at Fordham Gabelli School of Business in Columbus Circle. Sorry,
Oh, okay.
Columbus Circle.
Hi,
And
Bonnie.
Are you based in New York?
I was. Bonnie knows my
Yes.
story. I sold up there and I moved down here into the central Jersey now, Princeton area. So I shouldn't say it like that. Jersey's great. I'm not. I don't know.
I've been in Princeton, and when I go through, I say I don't even know how people even leave this town, like to go anywhere. It's like so beautiful.
It is. But Bonnie knows my background. I like violence and noise, so I like New York City more. I'm from Chicago originally, so I like a lot more. It's just it's
Oh, okay.
quiet. My kids they get to grow up near there. I don't know why I'm wasting time with this. Sorry, that's on me. We have a lot of family down here, so like they get to grow up near their cousins and all that. So my kids. What am I trying to do in life right here? I'm trying to share a screen with you, right? Okay, I found it. Got it. Boom. I am
Valuation.
here. There you go. I'm gonna do it. Let's do it this way, if you're cool with that. And then let me know. And I'm just gonna go with this like very quickly. I don't want this to be an educational tool, but like this is kind of how we do it. And I've wrote it very elementary. It's kind of a design from the course, meaning people like there's complex numbers that you deal with when you get into actual deals. But when you want to, what I thought, the guy I was 15 years ago, and I didn't know this. I love finance and investing. I can't stand accounting. I still can't, but I'm actually decent at it now because I've had to be. But now, Luckily, I'm old enough, I can hand it off to some junior folks to do most of it. But one thing I thought, hey, let's put very simplistic numbers when I'm kind of, these Zoom calls I would have with people are telling them how to navigate a deal. Put some simplistic formulas that they can put their complex numbers into 3, 6, 9 months down the road, a year down, and then it will make sense and how they can actually properly vet a deal if it makes sense for them. So that's what I'll kind of show you here. So we, it's kind of similar through, and it's going to seem a little elementary, but I did color-coded stuff because it's easier to follow the numbers. I was just looking in my mind 15 years ago how I'd want to do this. So hey, anything in yellow is pre-money valuation, previous numbers of shares. Blue is post-money valuation, post-investment of the new shares, and green is the investment, post-investment, the total number of shares. Just follow the color codes and it'll kind of make sense. I know it's like we're fifth graders, but I don't mean it to be that way at all because it gets kind of a little wonky here. And let me move this guy. So here's a new company, Series A financing. That's what that's meant to be. So very simplistic numbers, right? So if a new company is worth 5 million with 1 million in total shares, I kept them simplistic. Founders own all $1 million, 1 million shares, so 100% equity, right? This is pre-money before any money was invested. So then investors, new investors, make a $1 million investment, simple numbers, into this company. They negotiate to receive 200K newly issued shares for this. So how does that impact the rest of the whole play here, right? So this is simple numbers again. The shares in the new company is very simply 100. The initial shares were 1 million plus the new 200,000 shares gives you 1.2 million new shares. And now after this investment in this Series A, the total valuation would be very simply 5 million plus 1 million equals your 6. Now let's get into the fun stuff. Okay. Here now, post-money valuation, value per share. How do you actually calculate these things now that we have those simple numbers out of the way? So post-money valuation equals your new investment times the total post-investment shares over your shares issued for new investment, right? This is the kind of stuff that you need to know when you know how much liquidity, how much equity you should give up for receiving capital, right? So I want you to just be comfortable with these terms. Anyone that comes to me, if they're seeking this kind of guidance. So you calculate the post-money valuation like this. It's the 1 million that we get from new investment is the 1 million, 1.2 total new shares, 1.2, 200K shares that are the new shares only. So it's 1 million times 6 equals 6 million. Again, very simple, right? I did this. Now, how do you calculate the value per share? It's basically post-money valuation over the total post-investment shares. And again, you're going to deal with tens of millions of shares. In a new startup, you usually issue 10 million shares because then as you get diluted, you don't have to have, I own 40,000.367 shares. It's always going to be a round number. I own 45,000 shares of this company that has 10 million or 100 million shares. So always start with this what seems ridiculously high valuation for a company that's worth maybe $3 pre-seed, right? But eventually as more capital comes in and you can easily distribute shares and all of that, that's kind of that's why we start with this incredibly high number of shares. I did 1 million here for simplicity. And then you calculate the value of share by doing this. It's the $6 million post valuation over the 1.2 shares gets you at your $5 per share. That's how much you know that your share is worth at that point, right? Simplistic model. You put your complex numbers in later. Now, what's the founder's equity stake and how is it diluted over time? So the number of shares they previously owned, which was 1 million, over the total number of shares new shares is this. So you're down from 100% ownership to 83.33% owners. Whether you are 4 founders or 2 founders, you're splitting that 83.3% now. You're initially, before investment, splitting 100%. So initial shareholder ownership was diluted from 100% down to 83.3 after the Series A investment. Again, this would be with numbers that are probably in the 2 to 7 to 10, 12, 15 million range. We did $1 million here for simplicity. So this is how we do it on the cap table, very simplistically. In the course, we kind of go deeper, but the founder, had 1 million shares up front and pre-financing round, right? Total was this. Ownership stake was 100%, boom. Post-financing, Series A, you have 1 million, plus you added 200,000 new, 1.2, ownership, 80, and now the ownership stake after this post-Series A financing is 83.3%, 16.6%. In here, you also have priority and all these things at the cap table. We get into that into like a cap table section, but that's kind of how you do it. Series B. So that's kind of how we calculate. You want me to do one thing? Want me to play one video for you? Because here's what I did. I took these very unglamorous elementary PowerPoints. I spoke to them, I recorded my voice and sent it. And you can see what they did and how beautiful they made these videos appear. The editing team did it all. And it's kind of then it's the next step of this. You get Series B financing. How is it depicted? And that's how we kind of did it. And then let's go into whatever kind of questions you may have. I think that might be helpful for folks. Okay, let me just find it. Was that helpful a little bit? I mean, it was very elementary, but was it helpful?
No, it's useful.
Oh, yeah.
Okay, great.
Yeah.
Oh shit, my bad. You can't hear that.
Yeah. And I do have a question related to that when you get an opportunity.
Yeah, you want to do it now or before after the video?
So my question was like, if let's use the next scenario. Is it better to issue 200,000 new shares or to give 200,000 out of the original 10 million?
Okay, it can go either way. It can go either way, right? So that's a great question. I do explain that later. It could get complex now, but I've seen it done both ways. Usually when you start with a tranche of 100 million shares or 10 million, it's better just to give it from that lot. That's why you started at such a high number, right? To just so there's all around. Great question. For this, since I started with such a low number, I added more. But sometimes you add more because as you get into Series C, Series D, and there's a tremendous amount of ownerships, you have employees, founders. Hopefully you're not giving equity to contractors, right? You just want to give them a cash out type of play because you don't want them having ownership in something you built. They did something for you for 6 months. 6 years later, they get to reap the benefits of it, right? So you don't want that. So, but that'll come up that'll come up. I
Okay.
appreciate
Yeah.
that. Hold on, let me get
Because
to
we
this.
debate back and forth about that. Like my opinion is, if I have 10% of zero
Yep.
and 8% of a million, there's it makes a difference to me. I can have 100%, and if it's worth nothing, I got nothing, and I'd rather
Fair
have
point.
10% of something.
Well, that all goes depiction on your valuation at the share per round. So you know what? This might sum it up too. Here, hold up. Let's get here.
Thank
Can you see this?
Welcome back.
You hear
In
it?
this video series, we're
Yeah,
going
it's
to
going.
discuss
Yes.
You can see and hear it?
Yes.
Okay, sorry, my bad. I'll shut up now.
Welcome back. In this video series, we're going to discuss Series B financing and its impact on the investor, the founder shares, and how it's depicted in the cap table. So again, the legend: yellow, pre-money valuations, previous number of shares; blue, post-money valuation, number of shares; and green, aggregate amount of shares. How do we do this? A new company receives Series B financing. So the new company receives a second round of financing, Series B. New investors will invest $2 million new dollars for 300,000 newly issued shares. So 1.2 million shares outstanding prior to this new round, plus this new 300,000 newly issued shares get you to 1.5 million total shares after Series B financing. That's it. How is this depicted in a formula? Post-money valuation equals the new investment multiplied by the total post-investment shares divided by the shares issued for the new investment. Again, follow the color legend to know where the numbers are coming from. So the post-money valuations in a Series B equals $2 million multiplied by 1.5 million total shares divided by the 300,000 new shares. You arrive at a valuation of $10 million. Pre-money valuation in Series B, what is the 10 million? That is the new valuation minus the 2 million new money equals $8 million. That was your pre-money valuation. Now, the ownership dilution, what happens? How much is each new share worth? So the new value per share equals post-money valuation over total post-investment shares. So that's $10 million divided by 1.5 million shares equals $6.67 per share. So the founder equity stake has again been diluted. How do we depict that? So the number of shares previously owned divided by the total number of new shares. That's how your formula is arrived. So initial founders ownership diluted from 83.3%. Remember, after the Series A investment, that was the round, to 1 million shares divided by 1.5 million shares. And you arrive at a 66.7% dilution share. They own less of their company now. Now they used to have 100%. Now after 2 rounds of investment, they're down 33% ownership, but the valuation of the company is worth more. So every financing round dilutes the ownership of the original founders and the prior investors. You'll see this in the next table. So how do we depict this in this cap table? So in the pre-financing column, look at the number of shares. Owner had 1 million. Owner has 1 million, I should say. Series A investor has 200,000. Series B investor was not there in the pre-financing round. Ownership stake was, as you saw from the previous round, 83.3%, and 16.6% for the Series A investor equals your 100% total. Now, post-financing, after the Series B, the number of shares is 1 million plus 200,000 for Series A investor, plus the 300,000 new shares for the Series B investor. You have 1.5 million shares. So the number of shares has gone up, and the ownership stake has gone down for everyone. So the owner now owns 66.67% of their own company because they had to receive outside funding, thus give up some equity. The Series A went from 16.6% ownership to 13.3% ownership. And the Series B investor had negotiated 20% ownership stake in here, in this company. So that's where we arrive. So that is Series B calculation. Again, plug in your own numbers for your company so you can utilize this formula. In the next video, we're going to discuss cap tables and VC exits and expectations. See you there. So that's kind of it in a nutshell. And they did it, you can see from my kind of crappy PowerPoints, what they were able to create with their these videos. The editing was pretty good from them, right? And they did a really good job, I thought. So does that kind of explain it, how a lot of this stuff works? And we did it kind of simplistically. And then we, hold on, I could show you. Our whole thing is people want, we can't be in every meeting everywhere to explain this to them, but I thought this is just a kind of a quick, efficient way to explain it. And then you can just plug in and I can keep referencing. I'm a kind of guy, if I read something, I'm going to forget it in 2 weeks. If I listen to it or watch it, I might remember it 2-3 months later, or I can go back and reference it. Easier for me to reference a video or audio than reading. Other people, I think 90% of the world is reading first and they retain it better. I'm just built a little differently. I'm just weird that way. So I thought, let me do this. But Social Wave HQ was the group that I hired to do this. If you ever need something, they're fantastic. It took about a good year to do it because there was 35 odd videos, 40, and then another tranche of them. But I'll show you like what we, hold on. Oh, Bonnie, you said something, but here, I think this is wrong. Hold on. Well, let me do something. Yeah, I'll come back to you. Hold on. Thanks for being patient with all that. I appreciate it. Now, so this is kind of what it, here's how we did it. This is what I thought. These are the questions that I received the most right here. So module 1 of these videos is Foundation of Venture Capital, what it is, how you deploy a $100 million fund, venture, effective pitching, product market fit, different rounds of funding, how that impacts what size checks, what the difference is between East and West Coast, what it was, what it is now, TAM, SAM, SOM, right? And then navigating metrics and mastery in the next module, due diligence, calculating all the metrics. This is the quant heavy. This is my nerdy section, which I go nuts on. I love it. And then VC cap table type stuff. And then there. And then in the last module, we kind of go over like, hey, pre and post money. If a new company, this is the video you just saw right here. This is Series B. This is the slides I spoke to, and this is the next thing we saw. And then term sheets, equity division and dilution, how you do that between employees and everyone, SPA and some legal documents, and then customer acquisition costs, CLVs, and all that kind of stuff. And how a new company, how you deploy capital if you sell for a profit or sell for a loss. So that's kind of what we kind of go through there. So if you have any questions on that, do let me know. But I created that because these are the questions that most people have. And this would be the simplest way for you. Hey, if I'm going to do a deal later on this year, I'm exploring it, or I want to do multiple deals this year. I have some capital. Either the course was built for like more of a founder and an LP. I have capital I want to deploy as a limited partner, put it in a fund. A GP could get some value of it, but they may know this, or it's as a refresher for them, but it's really your founder. How do I effectively pitch to raise $3, $5, $10, $15 million from somebody? I would say right now, if you're looking for 15, go out asking for 10 to 12, and then you might get an up round type of thing. But it's gonna be out there but tag some like Xerox did with crypto or something back then a couple years ago, and remember their valuation went way up.
tag some AI play and you'll raise some capital. But have a vetted, true play, how AI you've integrated and actually providing value for the consumer. Because at the end of the day, we're coming in to help the founders win and find a market that helps consumers win. So consumers can get tremendous value and founders can extract their returns. And that's how we win at the end of the day, the venture world. Does that kind of make sense, what I kind of just threw out there?
Mhm.
Oh, good.
Yeah.
Okay. So that's the entire series. And then since, I mean, Bonnie, and this is, okay, you're going to look at me like this is Jack. I swear, Jackass is all about, that's out there now. It's all about, I'm not trying to sell it, but if you want it, it's there. I wanted something very low cost. So we did like a 20% discount for all of Bonnie's folks at like 100. It sells for 200. I wanted it under 200. So down to like 157. And then we have, just so you know, there's another layer, and that's just straight to 35 videos, 5 minutes each. And then we have another layer that we're working with. Bonnie, you know the gentleman, and Scott, you'll meet him in May, it looks like.
Yes.
I'm working with one of the partners from that group. We have an accreditation program. So there's NFL and NBA athletes, any athlete, sorry, but the ones that we know, they, some leagues, if you're in the league for a certain amount of years, they'll give you some capital towards education. So we thought, well, we're already working with a lot of these folks, and if they can be accredited for something, get an accreditation program, have it be a part of that. So there's some groups on the West Coast that we're working with. With high-profile campuses. Once it gets launched, this will be part of a premium. Like we'll probably charge quite a bit more, but they're going to get access to, like, some of those VCs will sit in on some of their PowerPoint pitches, help them perfect their pitch so they can get out and actually raise capital, or different scenarios. So we're putting a lot of templates, some workload outside of the videos in that kind of premium model. So I have 4 tiers to it, and this is the kind of like the middle tier, essentially. Yes, Ian.
I did put the link in the chat so that the
Was that the one from before? Or is that an active one?
yes, it was the one from before. Why is that not active anymore?
I may not be. I don't know. I'll give you a new one. But go ahead, Ian. You had a question. Go for it.
No, I was very happy to see this. We spoke before, and
Yep.
I've taken a couple of courses. I took the Venture Deals course, and I took the Laconia Capital. And I would say your presentation compares favorably with the way they do it. I mean, some of those concepts are a little tricky to understand. For me, I like reading, but reading alone doesn't solve the problem. So, like, to me, like what you've done is a very useful addition. For some people, it might be better than the reading. I do find one point that I think you might want to consider sort of emphasizing is that it's pretty commonly known that a lot of founders have trouble with their venture deals. Like they do it, but because they're not so expert in all the tricky aspects of it, in some cases they end up being disappointed by the way things go in terms of how their investments are provided, the capital is provided to them. And maybe it might be interesting to talk about pitfalls, like catches or things that happen to entrepreneurs who are not fully aware of all these details and how to protect yourself. I know that maybe it's taking a slightly negative tone, but I think that it might be helpful to people.
I do like it. I was happy, and I want you to bring me down a notch, so I appreciate that. Yeah, I'm kidding. No, so I do. No, I think there's a phenomenal point. I think there's an opportunity. So I think you're bringing up a great point. So in that other tier where they're going to be having direct access to us, like let's say for an hour a week or half hour a week or every other week, whatever it is, we're going to get feedback from them. What else? And then we're going to see what are the gaps. What have we not provided that they're actually looking for? That is part 2. But Ian, that's an excellent observation. I think we're going to be, without knowing it, you probably just hit on something we'll probably have to create something on, a video on at some point.
One more point is about the accreditation. We discussed our own project, and I told you about our kind of struggles with accreditation. We took kind of like I don't know, maybe not the absolute best approach, but your approach seems to be to work with institutions in the West Coast.
Yeah.
So your accreditation would come from them. Is that right?
Yeah. So I'll be very frank. Okay, I was pretty close with the NFL alumni. My buddy was 10 feet closer to the decision maker. We were all speaking to the decision makers, but it takes a long time, right? Because they want to make sure we're vetted and all that. I get it. So it takes a long time to unlock it. But they happen to be working with these 3, and they're prestigious universities. It just happened to be on the West Coast. I would have loved it if it was my backyard on the East Coast, but it was on the West Coast. And then it's going to be part of another program. This is one course within a part of an alternative investments program, exposure or finance or accounting, whatever they're doing, but this is one part of that. So whatever they charge per course there is what they'll charge for ours. So they charge like $7,000 to $10,000, $12,000 per course at some of these universities, right? But then we're figuring out our sweet spot, but it would be that higher price point. Before that, we have to provide more value, which would be that one-on-one, and then they get direct line to a bunch of venture folks as well, which is just buddies. I'll just have them come in that are really good in certain domains.
Yeah, that's great. So I'll follow up with you on this because you also obviously, have asked me to possibly offer the same discount program to my contacts, and I wanted to follow up with you on the best way to do that.
Yeah, and then even for your thing, and we'll speak offline, is for what you're doing where you're the COO. That's how I put it in front of the people that are the decision makers. They'll take their time to get back to you probably, but we're waiting. We're in the waiting period.
Got it. Okay,
Right.
Sounds good.
Yep.
I'm impressed. I think you're on the right track.
I appreciate it. Yeah, and hey, I have to give all credit to the editors. You saw my slides where they were working with mud and they created a castle. So,
Yeah, no, it's very, very nice. I like it.
I appreciate it. Thank you, Joseph.
I got a few questions, comments, points. I don't know. So the calculations, to me, feel like you can actually create just a simple template that people can download and plug in.
Yep.
That's maybe that's part of the course, maybe it's not. As you're doing that, I was like, I've been in the startup space a long time. Everyone's talking about valuations and dilutions, and they're throwing these terms around. Most people don't understand it. That was a very easy way for people to understand it. That's a rosy picture. Obviously, everything was a step up in value. Maybe you could, I assume the calculation is obviously going to work the same if the valuation goes down, but you hear people talk about, oh, the value of my company is X. You're valuing the shares there. So maybe you could talk a little bit about when people say, I value my company at $10 million, are they pulling that out of their, behind, or are they actually using a calculation like this? You see that on like a Shark Tank type of thing all the time. And then the other piece is debt versus equity. This is all equity. How would you deal with debt?
Yeah. So, great point. So we do deal with down rounds in here. We do discuss that in another video. So if you have, like, I think we had up to 3 rounds of investors, so Series B even, and then you sold, let's say the valuation was 10 million, but it sells at 5 million. How does that capital get liquidated? So the preferred shares would then convert to not common stock. They would take if they put in, they had 20% equity, they take 20% of that 5 million that it's down to. But if the valuation was 10 and it went up to 100 million, their preferred shares, they would convert to common stock and take whatever their equity was of that 100 million, right? Because that would be a better play for them. So they get that decision. So we do talk about up and down dilution, selling at a profit, selling a loss. I like the glossary idea. That's going to be in that accredited portion version. And we're just putting all that together and all the formulas, because it's difficult to you just need them in front of you, plus a video. I think all that together will help you work in like a workbook of sorts. That's a great idea. But yes, the debt to equity, we wanted this to be the simplistic one, but then I want that to be in there. That's a great point. I wrote that down actually. Thank you, Joseph. Alex.
Hey, so actually the debt equity thing that Joseph mentioned is a great topic, because debt is a lower cost of capital, right? If you can get to it. But I was looking at your the contents. Do you cover safes?
So
And
we
how do you look
will
at that?
in the next round.
The reason I ask is we're talking about valuation, right? And if you're a seed round or kind of pre-seed, valuation's always basically, this, like, I have an idea, I might even have a business plan, but it's all forecasts.
Right. So the
how do you get
safes
to
we are going to do.
valuation, and do you do safe
Yeah.
rounds in your topics?
We didn't discuss safes as a video. It's in there as a couple not throwaway lines. It's in there as lines, but it's not a dedicated video. It is in there.
Yeah.
But you're bringing up a great point. Whereas how does it pre-money? How do you get to a valuation? Who says you're worth $1 billion, right? You think you are, and your mom might think you are. That's great.
Yeah.
But so then we do vet those. But that is pre-money gets reset when post-money, when the first check comes in. Then you reset it, but then okay, this is going to sound horrible, but like maybe some people who have better experience in the space, maybe it's like some grown-ups in the space, when they come and put their capital in, then it gets set at a true valuation. So there's a lot of wiggle room, unfortunately, in the first in that first tranche of it. But usually you want people the first time if you want to raise capital from a venture folk, you better come in with a middle tier number, not too conservative, not too lofty. Oh, my company's worth 10 million tomorrow. No, it's not, right? Probably not. More than likely it's not. So it can be, but let's get you there, right? So that's what we want to people. So usually when they pitch to us, by the time they get to folks like us, they've kind of become more conservative about their lofty ambitions of, hey, our valuation is here. Let's really put it here. And then we want you to present scenarios. And we discussed this in one of the videos is like, give me, if the market is X, you're going to capture how much of X, right? In a conservative manner, you're going to capture only this much. Loftiest, you capture 80% of the market, it's here. But middle tier, you're going to capture probably right here. We want you to give those numbers to us. That way we understand that you understand the market. And then we'll go and explore that. And then in our due diligence, we unlock, oh, they actually can achieve this middle tier, or is it closer to the lower tier, right? So we want you to come in with those kind of three numbers essentially as to where you will land, what you can actually obtain, right? They total like it's TAM, SAM, SOM essentially. And then, but then in a really pinpointed model. Yeah. Did that answer your question, Alex?
Yeah, absolutely. Okay. Absolutely. Okay. Do you also cover like things like Y Combinator and accelerators, things like that, in terms of, that's earlier stage?
But they're great. They're great vehicles. And Y Combinator, if you look at they had a really great early run, and now it's just a little different. It's a little different scenario now. But for all these accelerators, right? Because it's hard to keep hitting home runs, right? So, but they're still great. I mean, some of the best companies we still talk about today are from there, right? OpenAI is out of that arena, I think, too. But I don't think we explicitly speak about any specific brands. I don't think, but I'm sorry. I do talk about Uber a lot. That's a perfect case scenario because 99.9% of the people are very familiar with the company who will ever take this course, so they can peg their numbers and see. I show in one of the videos how they pitched. I use them as the example how they actually pitched their weird idea at the time. Hey, we're going to get a random guy who's going to drive up to your place. Usually it was 100% of the time, 90% of the time it was a male driver. Is going to show up to your place. You're going to jump in this random guy's car. He's going to take you to the destination. You're supposed to trust that. So they had to prove that in their pitch, right? Airbnb similar. I'm going to have some random person sleep on my bed. If you're married, your spouse may not like that, right? But if it's a business model, let's not enter that. Those business models have been around that arena for a while. But like, hey, if you're traveling somewhere, we can actually earn money on our home, right? While we're gone. So these pitches, we discuss those. Uber is the one I use in particular. Like, hey, you pitch this. What is our unique proposition to the black car market, which is the private car market, which is like 4 billion when they launched. They grew it to 300 billion 10 years later. That's the perfect story we want to see. You've 70x the market essentially. And that's what we want to see, right? So we shared their specific. I do speak about specific brands in that case, but not about the accelerators, not yet. Yeah.
Okay.
John, go for it.
Hey, Atul.
My man, John. All right.
So you've been speaking a lot about venture capital, which is what you do specifically, obviously. I was just wondering if you had any thoughts on what's called venture equity. It's a newish thing, and I'm pretty interested in it. It's like a combination of venture capital and private equity. And I'm wondering if you've heard of it yourself and if you have any thoughts on it. Just wanted to pick your mind a little bit on that topic.
Well, so here, and piggybacking off of one thing Alex said, you brought up venture debt. I think you alluded to it. So venture debt comes into this model. They come in later. So they would come in and when Uber was around the Series A, Series B, when there's recurring revenues.
I'm talking about venture equity.
No, I know. So I'm teeing up the private venture equity. Yeah. So then they would come in. So venture debt would come in first. I'm getting echo. Sorry. So venture debt would come in and they put capital into companies that have recurring cash flows so they can have a good chance of capturing their capital again. The ironic thing is they come in way later, but they're the first money out when there's any kind of liquidation moment. So we've taken a lot of risk early on, the equity players, and debt gets to collect their money before we do any deal. Good for them. All right. It's a great space to play in. Now, getting up to your venture, private equity, I think what you're alluding to is essentially check sizes into the venture equity model are becoming much, much larger. So the private equity players are like, hey, we could play down in these rounds that we never touched before. So I think that's kind of it. I don't have a direct, but that's what I'm seeing it as. Like a perfect example, like what Tiger Global or the SoftBanks of the world did. A round was really supposed to be 10 million. They're going to pour 100 million in. That's PE type money, what you would put towards a PE size company, but they're putting those checks into early rounds, which causes tremendous ripples effects across the entire arena. It makes it harder for the companies that are sub 100 million to play because we can't match. So we're always not going to be a lead. We're going to be a follow-on investment, or we follow the lead. But that's what you're alluding to, I'm assuming. And it's coming. It's there because there's so much liquidity.
There's an article I just put in the chat about venture equity. It's about a guy named Ed Byrne. And it's like I said, it's a combo hybrid model of venture capital and private equity. And just from that diagram that you might see when you open the article, you take startups on a different growth course than you would with venture capital, but it's not as patient, I guess you can say, as private equity. So it's a newish thing, and I just wanted to
I kind of want to check it out, actually. Thank you for sharing that.
Yeah, absolutely. Because if I'm not mistaken, venture capital is a little hands-off, right? It's like, here's your money, we'll guide you, we'll support you whatever we can, but it doesn't get to the level of private equity where you actually install your own management team and operators of your own, right? And so venture equity is a hybrid approach where you take startups that would require venture capital, but you take a bigger equity stake and then you install like an operator in tandem or alongside them to help grow the company. Right.
So once I opened your document, it makes perfect sense what they're going for. You said it, you just nailed it, right? So private equity comes in, they're taking 80 to 100% ownership of the company. And in the traditional model, VCs, we're taking 10 to 40% ownership of a company. Why? Because we don't want to be as hands-on, what you just alluded to, which is a perfect point. We want the founder to have some equity stake because they're the brains behind this operation. It's their idea. And we want them to feel like, hey, if I grow this to $100 million, I'm not going to just walk away with a $5 million check. Right? I don't want 5% equity. I want 50, I want 20, 30, 40% equity in my thing. So that's why venture, we come in with just taking lower equity stakes. So the founder has more, right? And that's why we're especially, so to jump on another point that's coming straight from this, we also want, if we see a founder at the seed level has given up 30% of their company already, we can't do much with you. It's just not a good, it's not going to be healthy for you because at some point you're not going to be motivated to put your all into this company to grow it because your stake, your walkaway is only 5%. Well, I can just go get a job in the market, in a regular market and get, make real money and not have to worry about all this drama in the venture space. So yeah, I want to read about this, but it's perfect what you're saying. So they want more hands-on, but in the ventures arena, it looks like is what your article is alluding to. Yeah, I like it. It makes sense because there's more, as you get more liquidity, more capital in the markets, which we have a great run for the last 15, 20 years. We had tailwinds behind tech, essentially in America, let's call it. And then the rest of the world's catching up in a meaningful way as well. There's just more capital to deploy against great things, but also a lot of crappy things, right? So there's just more capital in the markets to back great ideas. Right. And right now we're being a little bit more selective, but it's opening up. But great point.
Another quick note is lot of, this is why you're building your courses, right? Is to educate and train entrepreneurs on venture capital so that they could have you invest in them. It could be a business development thing, right? So the point I'm trying to make is with venture equity, you install a manager that is experienced, kind of like entrepreneurs in residence, to help.
It's the private equity model. Private equity installs their own members, their executives, so because they know how to run that, they have domain expertise in that. I think Bill Pershman took Burger King private 15 years ago, whatever it was. So they installed their own management team, made it equitable in a sense, cleaned it out. They basically they get to the bottom line and strip out all the unnecessary fat, and they sell it to somebody else, right? They IPO or to another larger PE group that wants to take it on. So that's what they install it. They get effective management. We don't do that. They do that because they want to make sure if I'm putting $3 billion into this, it better be worth 3 or 4 to 5, 6 billion when I get out of this in 3 to 5 years versus, I'll get $10,000 back. They can't handle that, right?
But the point I'm trying to make is that with the entrepreneurs that you work with, a lot of them are inexperienced, and they could benefit from a little bit more guidance, and that's where venture equity comes into play, right? Not quite
Sure.
private equity because they're not fully built companies yet, but venture capital plus the guidance of private equity, hence venture equity. So, anyways, I
Yeah.
have your number. We'll text about it. I think it's something that you might be interested in getting into because I am myself, and I see where your intentions are, which is to really help these entrepreneurs get up and going to make money.
Yeah.
It's for everybody to make money.
Yep.
And I can see that you would be a valuable player in that space is what I'm getting at. So
Awesome. Yeah, I appreciate that. And then, and the venture folks, we don't, we talked about, you and I actually specifically talked about this smart and dumb money, right? I can write a check into tech and sports. If it's disruptive tech in the sports and entertainment space, media space, I might be smarter money because I can unlock relationships for you. It's not just a check. You need distribution for your thing. If I wrote a check into Alex's company, it's a fintech play, SaaS play, I'm more like dumb money. Or my wife's in healthcare. If I write a check into something, because I don't have a lot of relationships to unlock. I was a developer in healthcare 50,000 years ago when I graduated undergrad. It's been a long time. So I don't have as many unlocks there, but I do in this arena, right? So there's also that, right? So you want to, there's smart money is attached to good relationships and a Rolodex to help unlock value for these folks as well. And at least put them in touch
if you're
with
looking
people.
at venture equity, like install fractional executive, someone like me, for example, is what I'm getting at.
Yeah.
So a little bit more hands-on, but not completely, where you take the equity from the entrepreneurs, what I'm getting at.
Yep. Awesome.
Thanks.
Yeah, Scott.
Yeah, I just actually have a pretty simple question. I go to a lot of these meetings, I go to Joe's meetings and whatever, and there's lots of VCs on, and some of them talk about seed money or pre-seed, Series A, Series B. Do people in the industry like you, do you stick to one particular section, or might you do a seed and then a Series A, or an A and then a B?
Smart question. Great question. So we are going to be in the seed to Series A, and then the film SPV is seed, and then you consider this tranche what we're doing this year, Series A, and the SPV that we're doing specifically for sports that we're setting up, that's going to be launched within about a month and a half-ish, let's call it. That is seed to Series A, but we will then, it's not like we won't look at Series B rounds, maybe in our third or fourth check, let's call it this, without putting too much out there. If there's something that we don't need to be the lead on, someone else can be the lead check on it, but we could feel, hey, simply put, if there's a $10 million raise and some group is coming in with, generally it'll be like 20 to 30, 40, they'll take 30-40% of that round, right? They'll take 4 million of that, right? And then a bunch of smaller players will come in and finish that last 5 to 6, essentially. So we might be in that would get us into Series B-ish round if there's larger than 10 million probably. So we distinctly stick in our arena, because if you're in a 50 to 100 million, 150, you should be sticking in that arena. Series B, larger checks, right? Like 20 to, especially now the valuation has gone up and they're coming down, but they're still higher than they used to be. It used to be up to 2 mil was seed, 2 to 20 was A, everything beyond 20 is B, but you see Series A in the 30, right? Just numbers are just all over the place right now. But we stick in our domains generally. We raise capital for that arena, knowing, because each fund that raises capital raises with a specific thesis in mind. Hey, we're going to take this company from here to here. So usually they're at a certain range in their life cycle of where you can unlock value for them. That's how your LPs would jump in.
Thank you.
Yeah. Yep.
And that Series C to A, B, C, it's also risk reward tolerances, right?
Yep. You know, so funny though, Joseph, absolutely at Series B, there's higher risk. The earlier you get in, the higher risk, right? Higher reward. You do get diluted as more companies come on, and then the grown-ups come with the Series Bs and Cs, right? Like, hey, we have distinct capital. You are mature. You're mature enough to take it to the next step and grow and now at that Series B, you're looking to maybe knock out some competitors, maybe acquire some of them, acqui-hires, or just straight take them out of the market. Whereas we're just trying to capture market share, product market fit, market share at the Series A level. Seed is product market fit. So yeah, there's high risk, high reward at all those. As you get senior in the funding rounds, then yes, less risk, less reward potentially. Though you did see in the pandemic, Series C and up were getting 100% return because the money was just nuts. It was silly.
Well, it's also later stages may go public and have even larger returns.
So, you know, and Andreessen Horowitz, and I'm a big fan of Mark Andreessen because he went to my undergrad a couple of years before I did. And he was one of the first proponents of this. Let's keep companies private longer. And that all comes from, in America, we just had a nice run up in the financial ecosystems, and we've had more wealth and more capital that was, you know, captured in these models. So they could afford to keep them. And they also would say, hey, well, we put it here, it captures this much upside, which goes to retail folks like us in the stock market. I'm like, well, why should we give them 80% of that? Why don't we keep 30% of that for ourselves? And it's not that much more risk for us to keep this long, and then we'll IPO it, right? So there's a lot of that going on. And one other thing, I'll say, this is kind of nerdy, I know, I talk about numbers a lot, sorry. But usually it used to be within a 10 years life cycle, you mitigate all your risk across all your investments that you're participating in. In an SPV, it's really you raise per project. Hey, this is the project we have, us four are going to be the GPs on it. You put capital for this particular project. We already have 5 great projects lined up for this SPV we're putting together, so that's how we do it. Venture models used to be up to a 10-year cycle. Now, since you can't get that return sometimes within that 10-year period, and there's more capital, and more capital is deployed early on, to get that return, you need to get to an even higher number. So these life cycles for these companies to really get the true ROI is beyond that 10-year period. So sometimes you're seeing that 12, 13, 14 years. Alex, are you seeing that too? You're nodding your head. Are you seeing that as well?
Absolutely. I mean, I think you could probably speak to this a lot better than I can because you've been around it for longer. But the number of exits in the last 2 or 3 years has gone down significantly, right? Because the IPO market hasn't been there, etc. You're starting to see, like, you know, with Wiz, and there was another one, Green Acres, or Green Screens rather, do the acquisition, like Google is acquiring them for cash. Wiz, Green Acres sold out to Triumph. So you're starting to see some of that capital being returned and unlocked. But yeah, you've seen, I think the last 2 or 3 years, every VC says the same thing. Like, listen, we're fully deployed and we're raising money for new funds, but our own LPs, until we start giving them money back, they don't have the money to recycle, right? So it's kind of like everyone's waiting to monetize what they did 5-10 years ago.
You just nailed it, because you want that capital to come back into the ecosystem so it can grow other facets of it. So the ecosystem has to continue growing. But if that money's locked up, it can't continue pushing it, right? And then some people have to be responsible, like, hey, I'm here as an investor. I've grown it to here. If I make it simple, $1 million more, am I going to get 2% more value for this company? Or some other investment group comes in, I remove myself from it, whether liquidation or secondary markets or whatever. If someone else comes in and they can put that same million and get 10% upside, I should be responsible to say, let them take this, let me put my efforts elsewhere. There's opportunity costs involved as well. So that's happening. I think there's a realization coming, and a lot of capital is raised. We saw when they threw capital in, during the pandemic, that went towards paying down. Didn't go towards savings. So people didn't need it as much as the capital that went out there is what I'm saying. I'm not trying to knock anyone, but like, that's what happened. So it paid down debt and it did this. So people didn't need it for what they're doing in their day job. So then all of that went to driving it. We saw what happened. The markets went nuts, and that's why we're dealing with the inflation issue now. But it's a lot of people raised venture funds at that time thinking, hey, this is an easy game. Everything's up and to the right all the time. Well, now a lot of that capital is being returned to their LPs. Hey, we're not going to get you an ROI. We're not even going to waste your time or waste our time or your money. So LPs are receiving capital back. I fortunately not received any. I'm LP in some groups, but luckily they're still doing well. They're smart. I'm very selective because I know how weird it is. This space is just weird. and if you look at, and I'm going to speak so I've been an investor in the stock market. I don't do any of the work around Apple, Microsoft. I do research, but they do all the work, right? Tim Cook's doing all the work over at Apple. I've been in the tech markets for a long time because that's what I understand. The upside there has been phenomenal. We had a nice 15-20 year run because it was just great, versus VC returns comparably, without putting 150% of your effort into, versus someone else doing the work over there in equities. That was a great place to be too. So I'm not knocking on the venture model, but there's other models in place.
It's what you said before. It's diversity. You can't put all your eggs in one basket.
Yeah. Yeah.
The liquidity is a big issue, right? There are a number of people who can write checks and then kind of wait for 10 or 15 years to eventually
Yeah.
see a return is not as big as it used to be.
Right. Distributions get shackled like in between there too. So it's just a whole different arena now.
Absolutely.
Now that
Well,
we're
I think that's one of the
resetting,
biggest issues you see with kind of startup VCs, like the small guys that have smaller platforms and don't have that track record. Like a Sequoia can always get money, right? They've got a track record, decades long, and they're always kind of at a cutting edge, et cetera. They got their networks. But a new startup manager, even if they've got one or two good ideas, right? You basically have to trust them, and the valuations are all made up. I mean, they're not made up, but you know what I mean, right?
yeah.
So for 10 years, it's kind of like this is your return on equity could look really great on paper, but you can't ever actually get it
Right.
until you
Right.
monetize and sell.
And look, whatever we think of Elon Musk, I'm not even getting into the political arena, but like he's one of the most brilliant engineers of our time, right? And innovators of our time. Look, X, he overpaid. He raised at 45 billion, I think. He just raised another round at a down round at like mid 30s billion. Like I think he raised another billion. It's like it pegged the valuation at 33 billion. So it's already like almost like a 10, 11, 12-ish% loss, right? From what it was just 2 years ago when he took it over. So even the big guys make mistakes, right?
Actually, I saw a headline about X that the valuation is now what he paid.
Yes, I saw that. Yep. It was
So
today.
just yesterday, Bloomberg sent out saying, hey, he raised $1 billion at like 33 something. Hold on, let me look it up. That's okay. So if it's, and here's the thing, I get why the investors like the Oracles of the world, like they parked money with him because it's not about Twitter. It's about SpaceX and all the other deals he's part of that. Hey, if you help me here, because I committed, help me fund this now and do this. He's a smart guy. He's going to figure things out, right? Like he's just, how many, 6, 7 Fortune 100 companies he's probably launched that could be if they were separate entities, you know. Just wish he would not say some stupid stuff once in a while. But he can, I guess.
If you haven't read his biography, the Isaacson one, it's amazing what they cover in that and what's going on now. He's been consistent.
Yeah. I could put Kanye in that place, in that world too. I met him, I'm from Chicago, he's from Chicago. I met him at a music conference 20 years ago. He was talking like this when he wasn't a crazy billionaire, and now he is, right? So I think these genius minds are like that. And then the markets, whatever, no matter what happens in the markets or their personal net worth, they're still that same person, right? So it just comes out, maybe the platform's larger for them to get the voice and be amplified. Ian, sorry.
I was just going, sorry, go ahead, Bonnie. Yes.
I just wanted to add one thing. Elon Musk bought Twitter for one reason. Actually, he wanted to own a media company. That's all he wanted. That's all he cared about. I'm sorry, go ahead.
Oh, yeah, we're still going back. Well, go ahead, Atul.
No, all I was gonna say is it's smart. And guess what? I think, this, you're going to see the MSNBCs, the CNNs of the world, they might get taken out by the other party. I'm not making a political statement, but if they've always been leaning, well, let's just say left and Fox was right, you can see a lot of these companies being overtaken by certain figures that have capital just deploy it, and let's turn it this way, right? You can see that happening if they want to.
And it has been happening. The Washington Post, the Atlantic Magazine, all over the place.
And those are usually they're usually like loss leading to buy like a paper like that. Even if you're a billionaire and you just happen to be a billionaire in some other arena, buying these media properties, sometimes it's not a very fruitful ROI at all, generally, right? It's very difficult. Sorry, Ian.
Oh, no problem. I just want a very interesting discussion, kind of relevant to what I'm curious about. As you mentioned that you've got this new fund and part of its focus will be on disruptive investments in entertainment. Could you say a little bit more about what you're thinking about there? What kinds of projects?
So here, it's going to be very media centric is where I should have led with, but one of the entertainment plays would be, okay, how could I say it without putting too much out there? So one of the plays would be people post content to YouTube. This other group has an internal thing where athletes are posting their own content. They have their brands, they bring it here, and there's just a greater take on the AI play. But the reason I'm looking at them is like there's an education component too that we can do our podcast there. B, which is, that Whiskey UN, or this education component where you come here, you can actually learn something about investing in these types of plays. So that media platform is doing that when their advertising model is to share it more with the people, but the people that they already have signed up to in agreements with are phenomenal list, right? So you're starting a new YouTube-like platform. You don't want to try to compete with YouTube. There's no point. But you're creating like a niche arena, a niche platform for a niche group of people, and that's a high monetization value. So that's one. Another thing is, so eventually we're going to be looking at teams. And I can't afford, I think I probably said this every time I speak anywhere. I can't afford NFL. I would love to. An NBA team, I can't afford it, but like we can get into, I know another group I really want to work with is media rights for women's sports teams. WNBA has gone nuts in the last couple of years, so that might not even be a great ROI for us, but like women's volleyball, softball, you can aggregate them, and then that's a package right there. That's all I'll say, because I don't want to give too much away.
No, I got it. But going back to your course, I mean, so on YouTube, and people can comment on anything they see. How does that work in your course? Like if I'm looking at one of your videos and I want to add some comment to it so other people in the group can look at it, do you allow that? Or?
So on Kajabi, so it's listed on Kajabi. They can there, but here's what I'm thinking. Also, for each of those 5-minute videos, I created like 1-minute ESPN highlights of each of those videos. So that's what I'm posting everywhere. So someone I'm working with, she is our marketing strategist. She was thinking, mate, just put those 30 videos, the short ones, so a total of 30, 35 minutes each, put them up on YouTube, and then people can add their comments, and then maybe it'll drive, conversions or whatever. But yes, in the Kajabi, I think you can add comments.
Okay. Okay. Great.
And Kajabi is like a Udemy. It's like a Udemy teachable. I just found Kajabi because I could bring my Whiskey Who podcast in there as well. So that's
how do you
spell
that? Kajabi?
Yeah, it's K-A-J.
Okay.
A-B-I.
Oh, I'll check it out. Thank you.
And don't forget to put your video series link in the whiskey in the chat. That's all.
And put the Whiskey Who podcast, you said?
Yeah.
I'm going to get it right now. I just thought when Ian brought it up, I'm like, when I was chatting.
I know, he reminded me as well. And thank you, Ian.
Oh, here's one. We just did one with 2 CFL. So they played here, and they played there. The Canadian Football League. Anyone familiar with them? I'm not as much.
Yeah, I know it.
Oh, you would be, Ian.
Of course you would.
So here's theirs. And they both won the equivalent of the Super Bowl in Canada. They won the CFL championship. Both of them won it twice. So Tad, Bonnie, you may have met Tad, and he was on my panel. Tad and Nick. They're on my panel. So and then Vasu was on there too. So like they were just on, and they're hilarious because they know each other. And then I would just tee them up with a little thing, and they would just bash at each other. It was great. But then you get great football talk, and then they're both doing crazy good business endeavors post their game in the football life, right? So they're disruptive tech in the media space. You may want to look into that because maybe something I just mentioned is in that pod. Let's just put it that way.
I've been listening to the podcast, and it's interesting. Yeah, I mean, I'm not a big sports guy, but I still find it interesting, and I've been definitely checking it out. So pretty cool stuff.
I appreciate that. And it's not even supposed to be sports. It's just been sports lately. That's right. A lot more. I've had a lot more friends who just came on and who are from that arena. But we do media, tech. I like going deep in different topics. But thank you.
Good stuff.
I also wanted to mention that an investor friend of mine mentioned that some of the best and most successful entrepreneurs played competitive sports. And I wonder if the same is true of investors. Atul, since you work with a lot of the sports stars who are investing now, I'm just wondering.
Well, you know what it is? They're greatest founders. I've seen a lot of these greatest founders because they're not used. They've heard no a billion times, but they always made it a yes, right? So that's what you want in a founder. As investors, that's going to be the interesting unlock, right? Do we have enough data to say over 10, 20 years, are they great investors? You look at Shaquille O'Neal invested in Google early. Awesome. A lot of people have gone into traditional legacy, which is in franchises, like, in the 80s, 90s, 2000s, you had money. It's 2000s when the tech companies came in. You get the tech multiple. That's where it changed the game for everyone. But before they were investing, I have money, I'm going to go invest in Papa John's or, Burger King or whatever it is, right? Franchise model. And now, or car dealerships. Now there's these tech multiples. So let's see, when you aggregate data over a long period of time, are they phenomenal investors? Because look, people who are 24/7 in this space can be mediocre as well, right? Yeah. So let's see. I don't know. As founders, I've had great success with athletes who have been founders. who become founders and they've done well. Ray Austin played for my crappy Chicago Bears. I should say that. He was drafted by the Jets, played, I love the guy. We had lunch together during Christmas when I went home. He's a phenomenal founder. Phenomenal. You can't get anyone to say no to him. He'll make it a yes. He's that good.
It's that, and the investors say that they know how to be team players and they know how to build teams. They understand what it takes.
And we all have to take direction from each other, right? So that's, you're hitting it right there. That's perfect.
Hard work, getting around obstacles, a lot of skills.
Yeah.
Anyway, any other questions? I'm sorry. I mean, I just wanted to add those points.
No, that's great. How about Natalia? We haven't heard from her in a while.
That's Natalia.
She might be sleeping. I don't want to wake her up. So I tend to be boring. So, I do that to people.
Oh, nonsense.
Well, I'm just curious of what your top priorities are right now, because you got a lot of things going on. So
Yeah. So the cool thing is that's a great question. My wife asks me all the time too. So this new SPV, the great thing is it's a heavy lift early, then you set it up, then it's per deal, right? So that's great. It's similar to our film fund. It's heavy per deal. Then around that, it's we meet once a month on that one. It used to be every 2 weeks. Now we meet once a month on that one. So once we get this thing up and running, so that's it. It's the pure venture group. I'm part of 5 syndicates. That's kind of my, that's where I have my priority, but they're all similar-esque deals because I only want to invest in things I understand or someone near me has deep understanding of that I really trust and then they can guide me. Right. So in 2 or 3 syndicates, we'll look at some medical type of contraption or something in that service or, a product or service in that arena. I don't know much about it, but I need their guidance because they're doctors and they're buddies of mine or they're pharmacists or whatever it is. But I like to stick in this lane, but they're generally all within my wheelhouse. So it's kind of easier to maintain.
Okay.
Oh, Natalia. Yes. Hey. I woke you up. I'm so sorry. I put you to sleep and I woke you back up.
Oh,
How dare
no,
me?
I was here. I was here. Yeah, just to do some research. Yeah, I have a question. So I work sometimes with different startups and also investors. And a lot of times when entrepreneurs or startups, they have any ideas, I recommend them to have some sort of demo or the way how they could walk through what it's all about. You think it's a good way to do that, or is something else you see worked?
So you're saying have some sort of demo to demonstrate the product or service that you're going to have.
Yeah. Mm-hmm.
So I've seen investors get involved with the company when it's just an idea. If they see that there's, that founder can execute on that idea and bring it to market with some support. It is helpful to see a demo. If you have some brand new, out of the box, out of left field idea, it is helpful to see something, right? Often. It just depends on the arena. Like if you tell me I have an app that'll take, let's just take something that's already out there. I have an app that'll set up cameras in a basketball gym and we'll watch someone shoot 3-pointers from here, for any stance on the game. It'll measure. I understand that. So I don't need to see that as well. You can get AI generated data that takes and when you release the ball from here versus here, the better chance of it being a 3-pointer or 2-pointer, depending on where you are on the court at your height and all of that, and your velocity you're leaving it with. I understand that you don't need to develop that to come and pitch it to me. All right. I said, okay, then let's unlock how you're going to develop this and maybe we can work together. If it's something I don't understand, I probably need to see a demo of it.
Yeah,
of some
it's like
sort.
it's like a mobile games.
Okay.
Few of companies they have a mobile games and it's like sport related, or some of them would like in arena somewhere we can use mobile apps with the games. So far it's only for Android, but it's also the next step to make it more iOS friendly since it requires more work. So yeah.
So the game is already on Android phones?
Yeah, yes it is.
Okay, and it's out there for people to download and play.
Well, so far it's only for investors or
Okay.
people who will be interested to put some resources or funds in it.
Okay. So if the question is, hey, we want to get this over to iOS, you could just show the investors, hey, this is what we're going to replicate on iOS. And there's obviously different hurdles that you would understand better than I in that arena. But you could just show them the current Android version, or people understand gaming for the most part.
Yeah.
And they just want to know that what can suck you in and keep you there and have you playing and have you coming back, not just every day, but multiple times a day. They would love to see that. It's not great for society, but it's great for that consumer, that founder, that relationship that they're trying to get, right? So that's that. Ian, you're bringing up a great point. Someone asked me, hey, are my things AI created? My things, no. I went the traditional route. So next time I might incorporate some of that.
Yeah, I mean, they're making progress. I still think a lot of it is kind of like overwrought. Like it's not. My boss just went to an AI video conference in LA on Saturday, and he was not blown away by a lot of the stuff that he saw, you know.
Really?
Which is interesting. Because a lot of them are focused on these very short segments of video. That's their sweet spot, but that's not necessarily what people want in all cases.
Yeah,
Anyway,
interesting.
progress is definitely happening.
Yeah, and Natalia, if you want to follow up with me, like we can follow up. We can have a Zoom after. Yeah. If I didn't answer your question, I'm sorry.
Oh no, you covered it pretty well, but I'll definitely follow up with you anyway, for sure.
And Natalia as well. Any other questions before we tap out? Like that course is there if you're interested. No obligation, but I think it's helpful for people. I put it in a way that's helpful and it's cost effective, and it's the way I would have wanted to learn it. So then I can go and do something real and complex. That's what I wanted to put out there. And then we're working on the higher tier one for the accreditation program. Once that's ready, I can give some access to that too. There's going to be worksheets and all that, things you can download. And Joseph mentioned the formulas, the glossary. You need all of that to reference. You have that coming.
Yeah, they do. That makes life a lot easier, doesn't it? I want to thank you so much, and thank you everybody for being here. When is the next series going to be ready, or are you just starting it now?
I'm trying to get this one going as much as I can. It's been pretty popular so far, but yeah, I think I'll probably start that in the summer.
Okay.
Yeah, and then it's gonna be much quicker this time. Last time it took me, because now I know the editors and all that, so we're good. I had to switch editors halfway last time, but thank you, appreciate it. Yeah, I'll let you know.
Okay, we'll have you back. Thank you, everybody. Thank you, Atul. And everybody have a great day. We'll see you in a couple of weeks.
Yeah, you have an awesome group. I love this group. All right, take care. Thanks, bye.
Okay, talk to you a little bit later.
Thanks, bye.
Oh yeah, let me know, Scott.
Can you do a Google Meet?
Can we do Zoom and